Imagine you walk into a used car lot and the salesperson says the car is worth $20,000, but you have no idea if that's a deal or a disaster. That's basically what buying a stock feels like without fundamental analysis. Fundamental analysis is just a fancy way of asking one very simple question. Is this company actually worth what people are paying for it? Think of it like checking if the hype matches the reality. Kind of like reading reviews before you buy something off the internet. We start by looking at something called revenue, which is just the total money a company brings in before it pays for anything. If revenue is growing every year, that's usually a good sign. Like a restaurant that keeps getting longer lines out the door. But revenue alone doesn't tell the whole story, because a company could be bringing in $1 million and spending $2 million to do it. That's where earnings come in, which is basically what's left over after all the bills are paid, also known as profit. One of the most popular tools investors use is called the price-to-earnings ratio, or PE ratio, and it tells you how much you're paying for every dollar of profit a company makes. If a stock has a PE of 30, you're paying $30 for every $1 earnings, so you'd better hope that company is going somewhere fast. Then there's debt, which is the part everybody loves to ignore until it becomes a giant problem. A company carrying a mountain of debt is like someone maxing out 10 credit cards and then applying for a mortgage. It works, until it very much doesn't. We also look at something called the balance sheet, which is basically a company's financial report card, showing everything it owns versus everything it owes. A healthy balance sheet means the company has more assets than liabilities, which sounds obvious, but you'd be surprised how many companies are quietly walking a tightrope. Here's where it gets interesting. Fundamental analysis also makes you look at the industry a company lives in, not just the company itself. A rising tide lifts all boats, and a sinking industry, well, you can guess how that ends. A lot of people confuse this with technical analysis, which is more about reading price charts and patterns like you're trying to predict the weather by staring at clouds. Fundamental analysis is slower, deeper, and more focused on whether a business is actually good at being a business. Warren Buffett, probably the most famous investor alive, has been using fundamental analysis his whole career, and he basically turned it into an art form worth over $100 billion. He once said he never invests in a business he doesn't understand, which is honestly advice most of us could have used before buying random crypto in 2021. The goal of all this work is to figure out a company's intrinsic value, which is just a nerdy way of saying what the company is actually worth underneath all the market noise. If the stock price is lower than the intrinsic value, you might be looking at a bargain, like finding a designer jacket at a thrift store. One common mistake beginners make is thinking strong fundamentals mean a stock will go up tomorrow, and that's just not how this works. Fundamental analysis is a long game. It's more like planting a tree than winning a lottery scratch-off. The beautiful thing about this approach is that it forces you to actually read financial statements and understand a business before throwing money at it. That might sound boring, but your future self watching a portfolio grow will absolutely disagree. We're living in an era where information is everywhere. Earnings reports are public, and anyone with Wi-Fi can do the same research that used to take a team of analysts weeks. You have more tools at your fingertips than any generation of investors before you, which is either exciting or terrifying depending on your personality. If any of this sparked something in you, and you want to go deeper on how we help people make smarter, more confident investment decisions, go ahead and check out our links in the description.